However, we are living significant turmoil in our finance, banking, and economy. And Atul wanted. I was only briefly a banker, and you were polluted by long association with the global finance. And so, why don't you take us into
not a
this,
long 3 years,
the dark,
in my defense, 3 years only. But yes, it is true.
into the dark world of capital manipulation.
Exactly. I was an officer in India and left for Oxford and came then to the city of London. And me, wee laddie from an ancient land, from the fighting community of India, landing up in the mercantile world. And I entered that world in 2005, and in 2008 by 2008 when I left, it had all imploded. And so I saw the glory days of the bubble, and then of course the bust. And it seems to me that we're almost back to square one. So good. So this is what we will talk about. Banking turmoil, the global banking turmoil. Well, the facts, first of all. On March 10th, Silicon Valley Bank, SVB, collapsed at spectacular speed. Now, this is the biggest lender to collapse since the 2007-2009 financial crisis. The reason this bank got so much of press is because there were lots of Bay Area tech startups, and they were holding more than $250,000 in their accounts. In fact, that's the limit up to which the federal government insures these deposits. And there was a certain company, Roku, a streaming giant, that had $500 million in SVB. So the moment SVB collapsed, it threatened layoffs and bankruptcies in the tech sector. Remember, Facebook has just, or not just, but last year fired 13% of its workforce. And every single tech firm has been firing left, right, and center. And so SVB's collapse shook confidence first in the tech sector, but also in other banks. It could have led to lots of employees getting fired, B, startups closing, and C, very importantly, because the money startups have is the money that venture capital firms and private equity firms have put in. If you reach a certain stage, then private equity comes in. And so the private equity and venture capital players would have lost money. And so this whole fear of contagion, this whole fear of the entire system coming down meant that by March 12, in 2 days, the government, the Biden administration, had deemed SVB too big to fail. And so we were back to the future, back to 2007, 2008, when many banks were deemed too big to fail. And so the government guaranteed all accounts would be insured and covered. Ergo, no loss. Now, of course, this has brought up the recurring issues of moral hazard, too big to fail, systemic risk, all of that good stuff that was argued ad nauseum during the financial crisis and its aftermath. And why did SVB go belly up? Well, they had bet on long-term bonds. And actually, so do all banks. Banks usually have long-term holdings, and then they lend often short-term. But what it had done is that it had taken an unhedged bet on interest rates staying low, which to my mind is ridiculous. But then a lot of people had got used to quantitative easing. Remember, in Japan, quantitative easing lasted decades. After their financial collapse, they were just printing money. And yes, people were at one point keeping money under mattresses, and Japanese housewives were buying kiwi bonds. It led to lots of distortions, and yet the Japanese never saw serious inflation, so they never raised interest rates. What the Russian invasion of Ukraine did was that it was a needle that pricked the balloon of the global economy. Inflation returned, and yes, it could be, and of course before that, COVID had also created supply side blockages. And that meant that inflation had come to some degree. But after oil prices rose, after the supply of a lot of critical commodities was disrupted, inflation came back with a bang. And once inflation came back, then central banks were forced to raise interest rates. And the moment they raised interest rates, that meant that interest payments on debt became more expensive. That meant that fresh debt became more expensive. That meant that an entire series of assets suddenly that were profitable were no longer profitable. And SVB's unhedged bet on interest rates staying low boomeranged because the Fed now had raised interest rates. And now they felt the squeeze from the inversion of short, long-term bond rates. And now they were suddenly in a massive liquidity crisis. At the end of 2022, there were 620 billion of unrealized securities losses on banks' books. And this is basically not just SVB, but banks as a whole. And remember, on March 12, regulators shut down Signature Bank, another mid-sized lender. It was the third bank to fail in a week. Silvergate, an institution that was heavily exposed to cryptocurrency. And remember, cryptocurrency imploded. We know what was happening, in that world earlier. And, that collapsed on March 8th. So I'll hand it over to you, Glenn. You can explain why mid-sized banks were in crisis and why not others.
Here's what, I'm hardly a friend of Vladimir Putin, and the consequences economically, globally, of Russia's invasion are significant. But I still believe that that's a secondary factor in the inflationary phase that we're living, and in the current specific crisis on the banking industry, which has been triggered by the economic strains. To me, it's a classic, and I'm being, this is oversimplistic, but fundamentally, I think it's the essence of the issue. And I don't want to sound callous, as I always fear I do when talking about inflation. The bank, I think banks can be said to have failed because of, where do you want to start? 15 years of inflationary policies by the Western governments, in particular the United States, which saved the economy from a dramatic crisis and probably 25% unemployment and another depression. But the consequences are, when you prime the pump of the economy for year after year to the amount of trillions of dollars, as happened in response to the 2008 crisis, the quantitative easing that you're talking about, that you touched upon, Atul, and then trillions of dollars in spending, all of which I think was the right thing to do to attempt to mitigate the dangers economically and then socially from the pandemic. And then you have 4 years of grotesque deficit spending by the Trump administration, which lowered taxes, protected the wealthy, increased military spending, and was deficit spending unlike anything since the Second World War. And then you had continued efforts by the Biden administration to address, to mitigate some of these pandemic-related pressures. All of that is profoundly inflationary. So what happens to the banks? The standard model for a bank is that they will lend out at short-term rates, essentially, to consumers, and they will invest in longer-term bonds, which tend to give a better return. And the margin between those two is where much of their profit comes from. However, we've had an interest rate inversion because of inflation and these other pressures, so that the returns of the long-term investments by the banks are inferior to the obligations that they now have to their investors. That isn't sustainable long term. It would be if there were regulations that oblige the banks to maintain enough reserves to cover a larger percentage of their obligations, which was the case after the Great Depression and after the 2008 recession, much of which was undone again by, frankly, the Republican Party, which is deregulatory in philosophy. Then you have mid-sized banks, which rely heavily on a smaller number of investors and have a smaller pool relative to their overall assets of retail bank investors, you and I with our savings accounts in Acme Bank or Bank X. And so they don't have the cash on hand to meet this inversion crisis, and they have failed. There have been, I'm sure we'll find any number of instances of specific stupid decisions made by the bankers. That will always be the case. Not that bankers are stupid. People make errors, and judgment is subjective.
It's a question of incentives. If you have a quarterly, it's a question of incentives. If you have a quarterly reporting model, one of the good things it does is that it puts people's feet to the fire. It gets everyone performing. But one of the bad things it can do is that people are all very short-termist and no one cares about the long term. And you just maximize your pay. And if your pay is linked to profits you dole out to shareholders, then you take shortcuts. And I'll just very quickly touch upon two things, two different things. One is the point that Glenn made, which is that we've had extraordinarily loose fiscal policy. What is fiscal policy? It is governments spending and earning. So governments have been spending like drunken sailors. And that has been the case after the 2007, 2008, 2009 financial crisis, or 2007, when it all kicked in the aftermath, and then during COVID. And the debt GDP ratio of too many countries has been rising far too much. In fact, 2 years ago, as per the International Monetary Fund, global debt had reached 256% of the global GDP. And this is all debt combined. But let's be honest, with current growth rates, a lot of this debt is unpayable. There'll be haircuts. And so there is far too much of debt. So fiscal policy has been a bit too profligate. At the same time, especially after the financial crises, led by the Federal Reserve, but also the Europeans, also the British, and of course the Japanese began it all, and others, they've all been following extremely loose monetary policies. So they kept lowering interest rates to the point that at some instant they were in the negative, meaning that you were actually paying money to the bank to keep money in the bank. And this is just ridiculous, because it means that if you're a private equity shop, it's your incentive to take more and more debt, lever it up, and then get returns. Because let's say if you buy something, let's say you buy this phone for $100. If you paid $100 out of your pocket and you sold it for $110, then you make a 10% return. But if you put in $10 of your money, borrowed $90 from the bank, and sold it for $110, you'd make, well, almost, maybe not exactly 100% return, because you'd have to pay back interest on the debt, but you might be making a 90% return. And because all you did was spend $10 of your own. And so on the one hand, on the fiscal and monetary side, there was complete madness. On the other hand, given the structures of the economy, the incentives of the financial players, and the curious financialization of the global economy we have seen, we had more and more and more risky behavior. And that risky behavior brought down a giant. We've talked about mid-sized banks in the US. But let's not forget what happened in Switzerland. Boring Switzerland, which used to be a place where you discreetly keep all your ill-gotten assets, where African dictators and Indian politicians and Russian oligarchs would...
It wasn't even discreet, actually. I lived in Switzerland for years, and I literally, this is anecdotal, but it's not an exaggeration, I literally would routinely see Russian thugs with the highest paid rental women on earth walking the streets with briefcases of cash that they were taking, that they had stolen from Russia and putting into Swiss banks. It wasn't discreet at all. And that's not once or twice. That's countless times.
Brilliant. So we know it wasn't discreet, but Credit Suisse, which began in 1856, on March 20, the Swiss government rescued Credit Suisse from near bankruptcy. Its local rival UBS has taken over. This deal was hastily brokered. It has sent shockwaves throughout Switzerland and global financial markets. The bondholders have been cut out, and a lot of them were Asian, and they are furious and they are smarting. A lot of them were actually also Chinese. So we are living in a curious world wherein this drunken sailor behavior has gone all the way from the US. In fact, you could argue it began with Credit Suisse buying first Boston in 1988. But in recent years, Credit Suisse, 2012 to 2016, they had the tuna bond scandal. They organized 1.3 billion in loans for Mozambique, supposedly to develop a tuna fishing industry. But really, that money went to local officials and bankers. Then they had...
Which means it went back to Geneva.
Exactly. They went back to Geneva, or Zurich, probably. Zurich is where the banking is, I suppose. And then we had the spying scandal, in which the leaders of Credit Suisse, Tidjane Thiam and his second in charge, or his ambitious asset manager Khan, had a bish bash bosh. That doesn't matter as much. But the point is, Credit Suisse basically put 10 billion in Greensill capital. And it persuaded hundreds of its wealthiest clients to invest. And of course, Greensill, collapsed. And of course, a certain David Cameron was associated with it. Apparently, he was lobbying for them. So the long and short of it is that there was a persistent history of reckless behavior, not just on this side of the Atlantic, but even the big, supposedly boring Swiss. And so the combination of misaligned incentives because of easier and easier spending, government, fiscal and monetary, and with the nature of the financial sector, a globalized financial sector with no controls and no regulations, created the worst of all worlds. Glenn, over to you.
Yeah, just two concluding points, or possibly two and a half. Something we haven't mentioned, which I think is very important in this issue of the bank failings and the turmoil that we're living. We haven't spoken about the psychological aspect. The stock market and these investors, basically, this is a pack of lemmings.
Animal spirits. John Maynard
a bunch of lemmings.
Beautifully. Yeah.
We should all be out buying tulips or something, because it's as irrational as that. And there's been huge speculation and fear is the main point in this instance, not related to fundamental issues that are as alarming as the response and actions have been. So in a sense, that's horrifying, but it might be encouraging, because as quickly as these clouds can gather, they can dissipate, since it's not as related to a fundamental crisis in the banking industry as the fear would have. The fear would have it. The second thing is that is not touched upon hardly by anyone that I've heard, is that this collapse, bad as it is, it has a probable silver lining to some extent, which is that it is profoundly deflationary and on the economy, and I would have argued against the Fed raising its rates just now because of the deflationary effects of the bank failures. And deflationary pressures at the current moment, in a macro sense, are a positive thing. It's very hard to regulate successfully to avoid an economic recession or crash. But so far, the authorities have relatively successfully been reducing inflation without causing recession. So this is deflationary. And then my final point is, and I fear I'm a Pollyanna. I don't want to be, and I do not know the answer, but I don't see this as a structural crisis for the banking industry. I see it as crises because of some specific decisions and the inversion of interest rates for mid-level banks that are particularly vulnerable. I hope that's the case.
I'll disagree a bit. I will just say that I think this crisis is exposing a fundamental structural flaw. I disagreed with the bailout as it was done. I was then in the industry. I felt that bonuses should not have gone to bankers who had made egregious mistakes. This is yet another example of socialism on the downside and capitalism on the upside, which is fundamentally wrong. There will be a populist backlash. Indeed, there was with Occupy Wall Street and the Tea Party movement. I think too big to fail after the 2007-2008 crisis became even bigger to fail. So that means that the incentives are completely misaligned. You have more moral hazard, you have more concentrated systemic risk, and instead of merging banks and making them bigger and bigger, there is now need to break them up, because just as there are economies of scale, there are diseconomies of scale. And when an organization becomes too big, it becomes too bureaucratic, too layered, and the top dog has no idea what the bottom people are doing. And there are, the left hand doesn't understand what the right hand is doing, and there are potential problems storing up which are under the hood.
So to conclude, we are all living in what is truly historically a new world order and a series of overlapping competing systems in which the plutocrats once again will be bailed out by their friends in the government.
For those of you, a practical tip before we leave, because we've been asked, what does it mean for me? If you have money in the bank, make sure you distribute it. Don't keep it all in one bank. If you are doing business, then hedge for risk, because as we can see, the risk may be very different to the one that came before. The banks were thinking of just mortgage-backed securities. Now, that isn't as much of a risk, but interest exposure turns out to be. So be careful, be prudent, and listen.
Invest in defense industries.
Invest in defense industry, and listen to us every month. See you in April. All the best from both of us for now. Bye.
Join the conversation at Fair Observer and subscribe to our YouTube channel.